Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And this episode, we're going to talk about the latest news for January of 2024. We're recording this a little bit early, so there may be some breaking news that we'll cover in February, but we wanted to get ahead of the holidays. And there's certainly a lot of interesting developments going on in the oil and gas industry and energy in general. Justin, with potential Supreme Court ruling that could be a landmark case, an update on what some of the major oil and gas companies are planning for 2025, and then kind of a broader look at oil and gas industry and sort of what 2025 might have in store. I know there's been a lot of speculation, a lot of questions that I've gotten from clients and from listeners about Trump getting elected and what that's going to mean for drilling in the U.S. And we'll talk about all of that and more. And of course, we'll end with the rig count and talk about what's going on there. So what did you think about these stories, Justin, this month?
Yeah, I think they're pretty in line with what we were talking about last month in the news stories, Matt. There's, like you said, a lot of people are thinking that we're going to go back through a drill, baby, drill period and confusing whether that was a political thing versus it being, more of a technological thing and just a situational thing in the oil and gas industry. And to start out here, Matt, we're going to talk about something that has been ongoing, and we've been kept up to date with this through the NARO board. We have a couple of folks that are in Utah, so they keep a pretty close eye on this. But the U.S. Supreme Court appeared open to diminishing the scope of how federal agencies consider environmental impacts Tuesday in a case centered on proposed oil railway in northeastern Utah. The 88-mile Uinta Basin Railway, if built, would connect the remote oil-rich Uinta Basin to the rest of the country and refineries on the Gulf Coast. Railroad could quadruple the region's oil exports, according to a 2021 environmental review. And Matt, this is as this stuff usually goes. There are the environmentalists on one side, the pro-oil and gas people on the other side, and trying to work out to be sure that this is cleared from an environmental review standpoint, and that the impact is fully understood, at least. And it sounds like this now has gone up to the Supreme Court, who has agreed to hear this case and kind of review what responsibility federal agencies have for environmental impacts and what it is that they should have to consider with projects like this.
Yeah, it's really an interesting case because it's pretty important to the viability of growing more in the Uinta Basin. They're sort of constrained right now in terms of the takeaway capacity because the type of crude oil that they produce in the Uinta Basin in Utah is a waxy crude that has to be heated in order to keep it liquid. And so that requires these insulated rail cars, and it's kind of a cumbersome thing to transport it. Otherwise, they have to transport it by truck. So, certainly from an overall environmental impact and safety impact, I would think it'd be much safer to transport it via railway. But to your point, Justin, not in my backyard, that whole no fossil fuels kind of mentality, is not surprising. And so then you have the nonprofit Center for Biological Diversity, and then Eagle County, Colorado, where this railway would go through, opposed the approval, the initial NEPA review, the environmental review. And so it's been going back and forth in the courts and finally was escalated up to the Supreme Court, who agreed to hear the case in June. And so what they're asking the court to look at is the scope of that National Environmental Policy Act, or NEPA, and sort of, how far that should go, right? So you have a project that's 88 miles in Utah, and the opposition was, well, this is going to have a negative impact in Colorado because of the rail connecting to other interstate railways, and then those trains going along the Colorado River, through Eagle County, et cetera. And so then they're saying, okay, well, since A leads to B, B leads to C, and then C leads to D, and they're like arguing over C and D versus A and B. And that's the whole argument is, how far and how broad should these NEPA reviews be? And, that's the big question, because there's, this concept of proximate effects and proximate cause. And that's like the whole argument is basically like, what is proximate what does that actually mean? And it doesn't really mesh with that whole NEPA review. And so there's this argument back and forth of like, okay, how far away from proposed project do you draw the circle and say, okay, this is what the potential knock-on effects, like second and third order effects would be in order to look at, is it something we want to approve or not? So I think that's ultimately the argument. I think it is going to be an important case because ultimately if they constrain the NEPA scope to a smaller area, then it could change the way that permitting process and environmental review process is looked at and in the scope of it. So it really could be an important decision, I think.
Yeah, you said it, Matt. It'll be interesting to see because I'm sure they're going to go through a ton of case law and past cases and take a look at what's been considered before and question marks in the air, like you said, of is this a case of overreach? Is this, valid concern? So it'll be interesting to see what the Supreme Court has to say about where the impact lies or what limitations there are on how far out they can consider.
Yeah, it's going to be real important. And it's not just for the, obviously the Uinta Basin producers and mineral owners and royalty owners are eagerly awaiting the decision here. I know I've done a ton of work in the Uinta Basin for mineral and royalty owners, and that's always the question that comes up. And the conversations about their mineral interest is, what is the decision on the railroad going to mean in terms of the long-term outlook for the Uinta Basin? I think it would be very bullish for the Uinta Basin if this gets overturned and they allow the railroad to proceed. And for landowners that have, it's sort of a mix of mostly private, some federal, some state, some tribal lands. And so, big impact on Utah royalty owners if this gets overturned by the Supreme Court. So we'll be eagerly awaiting the decision here.
Yeah, you said it, Matt. And you might be able to speak to this better than I could, Matt, but that heavy crude is not something we find in a lot of parts of the U.S. Is that correct? So it also is, it decreases our reliance on some international partners.
Oh, absolutely. Yeah. Right now we import a lot of heavy crude from Mexico, which is, you could say, is largely favorable to the United States. And then we also have a lot coming from Venezuela, which in the past has not been so much. So it'd be great to have another source of this. And in fact, I read an article a couple of weeks ago about some refineries on the Gulf Coast looking at how they blend in, and actually they've been able to do it without having to overhaul any of the refineries, but they're able to blend in the Uinta Basin waxy crude into some of the light sweet crude coming from like the DJ Basin, other places like that, so that they can transport it to sell it as WTI in Cushing, Oklahoma. So that's the whole thing, is it has to have certain specifications in order to qualify as West Texas Intermediate, or that blend, and to qualify to be traded on the NYMEX as WTI. So it actually opens up, and I think if they have more ways to get that out of the basin, it's going to decrease the basis differential. So what that means is basically it costs money to transport it from the Uinta Basin to other areas and to make it usable in refineries. And, the further away you get from the Uinta Basin, the more expensive it is to transport it. But if they can inject it into a pipeline and blend it with some of these lighter crude oils, then that means that the transportation costs go down, which means that you should get paid more at the wellhead, and that would mean more royalties in your pocket if you're a royalty owner. Because for folks that have royalties in Utah may have looked at their royalty checks and see that the price that they're getting paid is a lot less than West Texas Intermediate, and that's why. So that could have a big effect there.
Yeah, which would be great for the royalty owners, as you said, Matt. All right, so our next one here is ExxonMobil new plan goes bigger on oil and even data centers. And Matt, the overall theme of these next couple stories here is that the drill baby drill may not be reality. So this article says, forget drill baby drill, Chevron plans cash baby cash. And so the article goes on to say here, ExxonMobil plans to invest heavily in several big projects over the next 6 years, even as some other oil companies are growing more cautious. The company said in an investor day on Wednesday, all that investment comes from at a time when most analysts expect oil prices to fall next year because of a glut, which may be why Exxon stock was down a bit. And the article continues, Chevron is cutting back on capital spending next year as it slows investments in the Permian Basin and some projects overseas. It's another sign that big oil companies are unlikely to go through a drill baby drill phase, even if incoming President Donald Trump wants them to. And Matt, they're talking about some different projects that they're looking at. Chevron's capital budget is about $2 billion less than the Ford budget, and they're prioritizing cash flow over production growth, which is a theme that we've kind of seen across the board here.
Yeah, I think that's the moral of the story. We've heard a lot of questions and excitement about Trump's announcement that we're going to be back in drill baby drill mode. The reality of the situation is that companies need to be fiscally responsible, and I think they're going to continue to be so, certainly the publicly traded companies, just because pretty severely beaten over the lack of capital discipline around pre-COVID, let's say, because they were basically looking to grow, right? And the focus wasn't on positive cash flow and reinvesting what they made. It was on growing the company. And so they would invest more than they made. They were borrowing money. All those companies that got overextended went bankrupt after the COVID crash and when prices went negative. And so, they were punished from that, and they learned the lesson, I think. And it's in a totally different mode in terms of publicly traded oil and gas companies. They're very much focused on capital discipline. And I think we're seeing that in, these capital budget announcements, like you mentioned, Justin, with Chevron reducing their capital budget by about $2 billion as compared to 2024. And they're prioritizing cash flow over production growth. So, Exxon is interesting because it is got some sort of unique things that they're looking at doing. They've kind of always been traditionally focused on oil and gas investments and not so much getting wrapped up in green energy and energy transition and things like that. So like they have been probably one of the laggards in terms of investing in things like carbon capture, solar and wind and other things like that. And it turns out that actually that's actually paid dividends to their investors because they've made more, I would say, fiscally responsible decisions. But interesting that they're totally understanding the broader scope and the need to employ those technologies, but doing it in a responsible way and not making it too big of a percentage of their capital budget. This article that we were taking a look at, and Justin mentioned, references Exxon's plans to build a natural gas plant to generate electricity for data centers. So we've talked a lot about this the second half of this year, about this whole push towards needing more electricity for AI and for Bitcoin mining as well, is very energy intensive. And these major operators, there's been some rumors by sort of fringe folks saying, well, the biggest Bitcoin miners and the biggest AI companies are going to be oil and gas companies because they have direct access to the energy that is needed to generate electricity and to power these things. And certainly this is, starting to come to fruition, it looks like, where they're going to build this natural gas plant. It'll have carbon capture technology to keep 90% of the emissions from being sent into the atmosphere. And it's going to be disconnected from the energy grid. So it'll be off grid. And basically they can have big contracts with companies like Amazon, Microsoft, XAI, other things like that. And they can just basically leverage this stranded gas. And I would see this being like a big theme, I think, in 2025 in the Permian as production continues to grow. And we're going to talk about what the outlook is for the Permian specifically here in this next article. But, really interesting to see Exxon going the route of like leveraging their vertical integration, building near the gas fields, building power plants there, and then connecting those up to data centers. So it's a great, really innovative way to leverage the energy abundance we have in the U.S. and then also to leverage trying to be like the leader in AI and all these things that are really going to become, I think, the base layer to how we interact with technology in the future. So I think that's a kind of a good development there.
No, you said it, Matt. Yeah, a very interesting shift for Exxon. And I would love to be a fly on the wall to see how they are viewing this as a customer type that they're going into. Because it makes a lot of sense, as you said. I mean, that it requires a lot of power. And not only that, it requires the ability to scale up and down quickly based on demand for whatever reason. So yeah, really interesting shift with Exxon. It'll be interesting to see if some other operators follow suit into getting into that game. Historically, Exxon has not really looked at fringe projects like this. So it's kind of marks a shift for them into exploring some other parts and growing into some other aspects of the business.
Yeah, definitely.
All right, Matt. So 2025 oil and gas industry outlook. And Matt, this article is a really long one. So we're going to hit some of the high points here, but it was a really interesting read.
Yeah, really interesting. And we'll link to it in the show notes. So definitely check it out. It's got some really interesting statistics. It's got some sub themes and different details and sub articles. And it's, like Justin said, it's many pages long with lots of useful graphics and things like that. So really interesting if you have minerals and royalties, and you want to kind of understand what the market might do next year, where we're going to see more consolidation and mergers, and what are the expectations around pricing, and what are the constraints, particularly in the Permian Basin, which was really the focal point of this article.
You said it, Matt. Yeah, and something that, which, we know of this, but it's interesting to see it really summed up here. Brent crude oil for the year was at $81 a barrel, and it goes through all of the different export rates, which I found that really interesting. We talk about them, but to see the cumulative over the year is really quite interesting. Natural gas, throughout this year has seemed to be, we've produced a lot of it, which has driven the price down. And then the data points sing to that.
Yeah. And I think it's interesting to note that we're still even with this whole capital discipline concept that we just talked about, we're still growing production. And so, with the rig counts that are down, and we're going to talk about where the rig counts are today, here at the end, but we've still been able to grow production, and that's largely because of the increased efficiency. So that means they're able to extract more oil and gas out of each foot of horizontal lateral length of these long horizontal wells, and the technology is improved and things like that. So it's, crude oil production for the year averaged 13.2 million barrels per day. That's up 2% from last year. Dry natural gas was down. It's 103 BCF a day, which was down about 0.5%, which really isn't that surprising because Henry Hub natural gas averaged only $2.10 per MMBTU, which was down almost 20% as compared to 2023. Really interesting though, like you said, Justin, that Brent crude oil really was pretty range bound is the term. It's, it kind of hovered between, I think, $70 and $90 a barrel for the entire year. So it was very tight range. And it was, I think there was some statistic they had in that article that said it was the most stable it's been in the past 25 years. So that's pretty interesting when you think that oil and gas, as they normally kind of go up and down, and there's this whole boom and bust cycle, and it's been pretty flat and pretty stable, which is good. For those of you that have watched the show Landman, which my wife and I have been getting into it since we both have worked in the industry, and it's really interesting, and we'll talk about that. We're going to actually do a kind of a fun, I think, reaction show here after the first of the year, where Justin and I'll break down sort of our thoughts on the episodes that we've seen so far. And I've mentioned this in my newsletter last week a little bit about my thoughts, but in that they basically talk about how, so Monty, who's the guy that's the billionaire who owns this MTEX oil company, who's the main company that's, all the characters work for, it is, really needs to be between, I forget what the exact numbers he says, but $75 to $85 or whatever. And that's sort of where it's been this year. And so that's kind of interesting. That allows companies and, both operators and service companies and all that to plan a little bit better and make sure that they don't have to make large adjustments to their capital plans for the year if energy prices are pretty stable. So they can kind of plan on, okay, it's going to be between, say, $65 and $80 per barrel. And that's sort of, we can base our economics, and it's a lot easier to predict what you're going to spend based on that because it's a tight range that it's sitting in. And so that was an interesting statistic I saw in this article. Justin, what were some of the other things that stood out to you? And it's particularly around the Permian Basin and what's going to happen there next year and some of the mergers and acquisitions.
Yeah. So, the article kind of goes into detail here, and something that I thought was interesting is it goes over the oil and gas industry takes, basically, and it has 5 takes that it breaks down. But as far as Permian Basin goes, so the relative strength in crude oil prices, oil to gas ratio is at a 10-year high of 40-1, and that's incentivized leading operators in the Permian Basin to prioritize oil operations, resulting in an abundance of natural gas production. And Matt, this is something I think that it's easy for us mineral owners to overlook. But that there's a lot of natural gas production that goes associated with producing oil. And large shale operators are exploring tier 2 and tier 3 acreage, which are generally much more gas heavy, to help offset flattening production from their tier 1 acreage, which would be the Permian Basin, and unlock invested capital, test new productivity and cost efficiency measures. The result over this investment in the Permian Basin, as far as going for the oil, has been natural gas production has nearly doubled to 25 billion cubic feet per day in the last 5 years. And we've seen this with prices. There's just too much natural gas in the market, which makes our last story on Exxon even more interesting. However, the takeaway capacity of natural gas remains highly constrained in the basin, with natural gas pipeline utilization exceeding 90% in 2024, pushing the regional Waha hub spot prices below zero. And the article mentions that as of early September 2024, prices at the Waha hub were below zero for 46% of the trading days in 2024, including every day since July 26th. And so, Matt, this has just been the story in the Permian Basin, is that you can't get it to market. And we've talked a lot about flaring over the last year and how they wanted to limit that because there's been so much of it going on. But this really paints the big picture of what's going on with that.
Yeah, and that's a great point. It's sort of a funny thing when you think about it, that the relative strength in crude oil prices has caused the operators to focus on oil operations, which results in more natural gas production. So that seems kind of counterintuitive, but the reason for that is because a lot of these wells in the Permian Basin in particular have a lot of associated natural gas. So that means it's like a natural gas that's produced as a byproduct of crude oil. And we have significant amounts, and it's particularly in certain parts of the basin that, talks about tier 1 versus tier 2 and 3 acreage. So tier 1 oftentimes has a lot more oil, a little bit less gas. It's more economic. Now they're kind of going out and broadening that target area into these tier 2 and tier 3 areas that have a lot more natural gas. And so as a result of that, you have wells that you're drilling that are, it could be argued that potentially they're like primarily natural gas wells because they have 2 BCF of gas that they're going to ultimately produce. And maybe they're going to produce 300,000 or 400,000 barrels of oil over the life of the well. So it could go either way, as whether this is an oil well or is it a gas well. But, what that means is they have this major natural gas pipeline takeaway capacity issue in the Permian Basin. And that's why the spread, they have this chart in here where Deloitte shows that the spread between the Waha and Henry Hub. So Henry Hub is the price that it's the kind of the benchmark price, the natural gas that you see reported. If Henry Hub, like we said, it would average $2.10 per MMBTU, per million BTUs, basically, over the course of the year. The spread has been more than negative $3 since 2023. So what that means is you have a negative gas price at Waha Hub. They're paying people to take the gas. There's just so much of it. So that's why when I say that, I expect to see more projects like ExxonMobil's plans to build the natural gas power plant there to fuel AI, I would expect to see a lot more companies that have a major footprint in the Permian Basin to do things like that, just to do something with the gas to get a positive return from it. Certainly it's such an opportune thing. But the problem with the West Texas, as you know, Justin, having grown up there, is that it's hotter than heck in the summertime. So that is a big issue because these AI computing centers generate a lot of heat. There's a lot of heat that comes off these computers and they need to cool them. And so that's expensive to do in the hotter environment. But, ultimately, if it's super cheap to get the electricity, then they'll do what they need to build the cooling systems.
Yeah, you said them at it. And it'll be interesting to see, over the 2025, we were talking before we hit record, and the article speaks about this too. The real evolution in the oil and gas industry we could see is infrastructure. If new pipeline projects will get approved, we can get that natural gas, we can get the oil to market. And if they're able to approve pipelines to go to these special data centers, that could be a game changer, like you said, Matt, because now you're not talking having to put that data center in West Texas. This could be in any part of the country if they can get those pipelines, grow the pipelines, get new pipelines built. So it'll be interesting to see if the supply and demand will get kind of worked out with that. There's also the natural gas export that is a question mark and could significantly help prices if they bring that online and decide to start moving forward with those projects.
Yeah, and I think, we're in talking about 2025 themes and what the Trump administration is going to likely do and where they'll have probably the biggest impact on the oil and gas industry. It will be by unfreezing the LNG export licenses and allowing for those to move forward, new licenses. And so those projects can go to FID, go get built, and then ultimately be a source of new demand for natural gas. And you mentioned another one, Justin, was pipeline infrastructure and like these unique partnerships that are potentially being looked at to help midstream companies. And so operators may be partnering with midstream companies to develop these projects jointly, or, providing funding. And, I think that's the thing that we expect to see is more consolidation in the industry. They talked in this article about the Bakken and Eagle Ford are sort of possible acquisition targets for next year because the Permian's kind of played out. The majority of the focus in 2024 has been in the Permian. There's been some massive deals done, and those large bolt-on acquisitions are pretty much all complete. But then the Bakken, Eagle Ford, other areas like that could be ripe for more mergers in 2025. And then, like you said, Justin, I think like thinking about federal permitting and this whole NEPA analysis, these pipelines require a lot of environmental reviews, and to the extent that they can streamline that, and if this Supreme Court decision overturns that blocking the railroad, then it could open up more of these pipelines. So I think that's another theme I think to watch for in 2025 to see what happens. But it's certainly going to be an interesting year as far as energy is concerned.
Yeah, you said it, Matt. And the article mentions a lot of mergers and acquisitions, like you mentioned, and we're going to continue to see that. And in West Texas, that was such the theme over this last year. And a couple years ago, if we're talking 22 and 23, we were seeing a ton of people flipping leases. It was a situation of having access to acreage and knowing that somebody would be interested in it. And I think that's slowed down hugely in the Permian Basin. So it'll be interesting to see as they're looking in the Bakken and some of the tier 2 and tier 3 acreage, what areas start to really stand out. And the story with AI, the story with the Uinta railroads could really change that throughout 2025. We don't even see it coming yet.
Yeah, I'm sure there's stuff that we won't even realize that's going to happen, and it'll be interesting to see how it develops. So yeah, and then I guess, on that same vein, let's talk about the rig count and what do we think is going to happen there? How are we going to see that developing in 2025, and where are we today, Justin?
Yeah, not much change, Matt. So over the last week, we gained one rig. That one rig looks like it was actually brought up in Louisiana, laid down a rig in Pennsylvania and 2 rigs in Texas. And from a year ago, Matt, we're down 31 rigs. And, every time I see the rig count this year, I've thought, wow, what a stability change from what we were looking at in 2023, where these were massive variations from week to week.
Yeah, for sure. I think we've hit the status quo like we keep talking about. And it's, you see the Permian staying steady, and those 2 rigs that laid down in Texas, they just moved across the New Mexico border, and those were rigged up there. So yeah, no change in the Permian. You have one rig added in the Haynesville. You lost 2 rigs in the Eagle Ford, which I'm kind of surprised to see. Added 1 in the Granite Wash. Everything else was flat. So not much going on. And again, I think it's going to be a story of capital discipline in 2025. So I think this, we're at 573 rigs as we're recording this. I would say between 570 and 600. I wouldn't be surprised to see it go up a little bit, depending on what prices do. If prices fall, then I can see they're losing more rigs. So say between 550 and 600. But yeah, I think we're kind of in a good spot now. And, if we're able to at least replace production and maybe grow it a little bit, I think that's probably the most we could ask for right now.
Yeah, you said it, man.
All right. Well, this wraps up our 2025 preview, episode here, and looking at the news and what's going on. And, certainly is going to be interesting. And, if you haven't watched the show, Landman, we're going to do a whole reaction to that. And we'll do a little breakdown of what we think about the show here coming up soon. And it'll be a little bit of a fun kind of break from what we normally do. But yeah, highly recommended. Very entertaining is my initial take, but it's got some issues which we'll dive into.
Yeah, man, it'll be interesting to see. We were talking about it before we hit record, and I've only made it through 15 minutes of the first show. So truly, Matt's going to be waiting on me to catch up. So I'm interested to dive into it. I loved what I saw so far, and it's set in Odessa. So looks like home to me.
Yeah, it looks like home. And I know you got to navigate the 3-year-old. And it's definitely not a kid-friendly show. So, I understand that constraint. But well, it'll be fun. All right. Well, Happy New Year. And let's hope that we have a great 2025 from oil and gas industry standpoint. No major crashes or booms. I think where we're at is a great spot. Hopefully some new wells will get drilled on your minerals in 2025. So here's to another great year. So thanks again for listening. We'll talk to you in the next episode. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.